Hi, good day. Welcome back. My name is Raymond Galor, Master of Management student at the University of Niagara Falls, Canada. I'm excited to have you join me for the 8th video on Fall 2024 Finance for Managers series. In my last video, we explored the 7th module, Introduction to the Time Value of Money. And now we're diving into our 8th module, Introduction to Bonds and Bond Valuation. So let's get right into it. Introduction to Bonds and Bond Valuation. Welcome to Module 8. Module 8 focuses on applying time value of money principles to debt instruments, focusing on bonds and their valuation. Bonds are a fascinating and essential part of the financial landscape. Whether you're a seasoned investor or just starting, understanding bonds is crucial. This guide will provide a clear and concise introduction to bonds and their significance in finance. Imagine lending money to a large institution or even the government. That's essentially what a bond is. A loan you make to an entity in exchange for regular interest payments and the eventual return of your principal. Bonds offer a way to grow your money while providing a steady income stream. They are used by governments to fund public projects and by corporations to finance operations and expansion. As an investor, bonds can be a valuable addition to your portfolio, offering diversification and potential for stable returns. Let's delve deeper into the world of bonds and explore their fundamental characteristics. Before we explore the complexities of bond valuation and market dynamics, let's establish a firm understanding of the key terms and concepts associated with bonds. Every bond has a face value, also known as par value, which is the amount the issuer agrees to repay the bondholder at maturity. For instance, a bond with a par value of $1,000 will pay the bondholder $1,000 when the bond reaches its maturity date. The coupon rate is the fixed interest rate the bond pays annually. For example, a bond with a 5% coupon rate and a $1,000 par value will pay $50 in interest each year. This interest payment, known as the coupon payment, is typically paid semi-annually. Understanding these basic terms is crucial for navigating the world of bonds. In the next section, we'll explore the different types of bonds and their unique characteristics. Bonds come in various flavors, each with its own risk and return profile. The most common types are government bonds and corporate bonds. Government bonds are issued by national governments to finance their spending. They are generally considered low-risk investments due to the government's ability to tax and print money. Corporate bonds, on the other hand, are issued by companies to raise capital. These bonds typically offer higher interest rates than government bonds to compensate for the higher risk associated with lending to a corporation. Within these broad categories, bonds can be further classified based on their maturity dates, coupon structures, and other features. For instance, bonds with longer maturities generally offer higher interest rates than bonds with shorter maturities. Understanding the different types of bonds and their characteristics is essential for making informed investment decisions. In the next section, we'll delve into the crucial relationship between bond prices and interest rates. One of the most critical concepts in bond investing is the inverse relationship between bond prices and interest rates. When interest rates rise, the prices of existing bonds fall, and vice versa. Imagine you own a bond paying a 5% interest rate. If new bonds are issued with a 6% interest rate, your bond becomes less attractive to investors. To sell your bond, you would have to lower its price to make it competitive with the higher-yielding bonds. This inverse relationship is driven by the concept of opportunity cost. Investors will always seek the highest return for a given level of risk. Therefore, when interest rates rise, investors will demand a higher yield from existing bonds, leading to a decrease in their prices. Understanding this dynamic is crucial for managing your bond investments and making informed decisions in a changing interest rate environment. If you enjoyed this video, give it a thumbs up, subscribe to my channel, and leave a comment below with your thoughts or any constructive feedback. Your input will help me improve and bring more value in future videos. See you in the next video, where we'll dive into Module 9, Introduction to Stocks and Stock Valuation. We will explore stocks and stock valuation, which is deeply rooted in statistics and time value of money concepts. Stock valuation is the basis for stock portfolio construction and investment decision-making.